Welcome back to Everyone's Talking Money. I'm your host, Shari, and I'm seriously pumped you're here. Whether you're 3, 2, 1. Hey, it's Shari. Welcome to Everyone's Talking Money. It's tax day. Did you receive a refund this year? Hi, everyone. I'm so excited you're here. Whether you're turning 3, 2, 1. Hi, everyone. I'm so excited you're here. Whether you're tuning in on your commute, sweating it out at the gym, or hiding from your responsibilities in your car for just 5 more minutes, thank you for spending part of your day with me. Today, we're about to get real and probably ruffle a few feathers. Because as we cruise into tax season, we need to have a little heart to heart that goes against every happy dance you've ever done over a tax refund. Today, I'm about to get real and I'm probably going to ruffle a few feathers because as we cruise out of tax season, we need to have a little heart to heart that goes against every happy dance you've ever done over a tax refund. Here's my hot take. If you're popping champagne over your big tax refund like you just won the lottery, we need to talk. 3, 2, 1. Here's my hot take. If you're popping champagne over your big tax refund like you just won the lottery, we need to talk. That refund, it's not free money. It's not a bonus. It's not a cute little gift from Uncle Sam. It's your own money being returned to you after you gave the government a nice interest-free loan all year long. By all means, still drink the champagne. We can't let it go to waste. I get it though. That deposit notification feels good. It feels needed. It's that little bit of extra breathing room, especially right now when groceries cost an arm and a leg and budgeting feels like a full contact sport. But if you're at your refund as the thing, 3, 2, 1. But if you're looking at your refund as the thing that swoops in and saves you, you're missing the bigger picture. That feeling of relief, it's a symptom, a flashing neon sign that we need to come up with a different plan. Here's the reality check. Your money wasn't working as hard for you the past year as it should have been. Now, am I saying you should be mad again? 3, 2, 1. Now, am I saying you should be mad about getting a refund? No, of course not. But what I am saying is we've got to stop treating it like some magical money moment. Today, we're flipping the script. I'm breaking down what a refund really means for you, why owing money at tax time isn't a financial walk of shame, and exactly how you can take back control of the money. 3, 2, 1. Now, am I saying you should be mad about getting a refund? Of course not. But what I am saying is we've got to stop treating it like some magical money fairy came in and plopped this money on your lap. Today, I'm flipping the script. I'm breaking down what a refund really means, why owing money at tax time isn't a financial walk of shame, and exactly how you can take back control of your money like the powerhouse you are. Let's do it. Here's the real unfiltered truth. A tax refund means you paid too much in taxes throughout the year. Period. That's it. The government took more of your money than they needed to. They held on to it for 12 months, used it for God knows what, and probably in ways you disagree with. And now they're giving it back to you going, here you go. And somehow we've been conditioned to throw a party over this. Imagine you gave your friend $200 every month for a year, just for them to safekeep it for you. Come April, after watching them have fancy dinners out every month, they hand it all back with a smile. Are you throwing 3, 2, 1. Imagine you gave your friend $200 every month for a year, just in case, just for safekeeping. Come April, after watching them have fancy dinners out every month, they hand it all back with a smile. Are you throwing confetti for them? Or are you side-eyeing them like, cool, thanks, I probably would have done better with it myself. By the way, how's the filet mignon? That is what is happening with your tax refund. Let's talk numbers. Last year, the average tax refund was about $3,000. That is $250 more a month that could have been sitting in your account, earning interest or knocking out debt. Or heck, just giving you breathing room. Instead, the IRS was playing babysitter with your money. Even at a modest 3% interest in a high yield savings account, you missed out on around $50. And obviously, you're not retiring early on that 50 bucks. It doesn't make that big of a difference, but it's still your money you left on the table. Or it's $250 less you would have had to put on a credit card and potentially paid interest on. So again, that extra $250 essentially cost you $50 if you were just putting it in a savings account. Or if that hasn't gotten your blood simmering, let's dial it up a notch. If you had a even at a modest 3% interest rate in a high yield savings account, you missed out on around $50. Obviously, you're not retiring early on that 50 bucks, but it's still your money you left on the table, and it's $50 the government cost you because they were taking too much taxes out of your paycheck. Or it's $250 less you would have had to put on a credit card and potentially paid interest on. Now, if I haven't gotten your blood simmering yet, let's dial it up a notch. If you had a $3,000 credit card balance hanging around at about 18% interest, which unfortunately is very normal, those $250 monthly chunks could have saved you about $270 in interest charges over the year. Now that's real money with a real impact. And if you're only making minimum payments on that credit card, you're looking at 4 years of debt and $1,200 flushed down the drain in interest. But adding that $250 every month to that credit card bill, you would have crushed that debt in less than a year. 10 months, boom, done. See you later. And you'd be out from under that financial stress way faster. And again, the government was just using that $250 every month for God knows what. Who would you rather have that money? You or Uncle Sam? And it's not just about lost money, it's about lost opportunities. How many times last year did you feel tight on cash? How often did you put off that oil change a little too long? Did you delay a dentist appointment because the copay felt like it was too much? Meanwhile, you overpaid the government and they were spending that overpayment. It's not like they were holding on to it in a piggy bank with your name on it and being like, Jessica paid us too much this year. Let's just keep it safe for her over here. Not at all. Yet here we are celebrating light refunds like they're surprise bonuses. And don't get me wrong, I totally get it. A big chunk of money feels way different than an extra $50 or $100 sprinkled in your paycheck every 2 weeks. It feels big. It feels important. And honestly, some of you use your refund like a forced savings account. And listen, if that's what you need right now to protect yourself from yourself, I'm not here to shame you. Behavioral economics is real. You know yourself and what is best for you. We're not robots after all. We have emotions when it comes to our money, and sometimes we need to trick ourselves into saving. But here's my challenge to you. What if you didn't have to trick yourself? What if you built actual financial habits that put you in the driver's seat? What if you trusted yourself enough to manage your money like a boss every month instead of once a year? Because here's what really happens with that big, sexy refund check. 40% of Americans use it to pay down debt. Okay, that's not a bad thing. But did that debt grow while your money was tied up with the IRS? 30% of Americans use it to cover basic expenses, meaning their cash flow is jacked up year round. Only 20% save or invest it, and about 10% they treat it like found money and splurge on the fun stuff. So the narrative that refund equals smart savings plan, it really doesn't hold up. For most people, the tax refund is a financial band-aid on a broken system, not some brilliant money move. And you deserve better than a band-aid. All right, now let's flip the script. What if you owe money at tax time? Cue the scary music, cue the panic, cue your uncle telling you you're bad with money. Take a breath. Owing a little money on tax day doesn't mean you screwed up. It could actually mean you won the game. Because guess what? It means you kept more of your money throughout the year. You used it. You invested it. You paid off debt. You lived with more breathing room. You weren't handing the IRS your paycheck every month like a well-behaved cash machine. Let me give you a real world example. A few years ago, I was talking to my friend about this, and I was standing up on my stop celebrating your tax refund soapbox, and we talked things out. And I said to her, listen, do you, it, humor me, adjust your withholdings so you get more money in your paycheck. I know it's crazy. Pay a little bit less in taxes. You consistently get a refund every year. Your income is going to be the same this year as it was last year. Just reduce your withholdings. And the first year, she owed about $800 come April. And yeah, it was a little bit of a panic for like 5 minutes because you're trained to think if you owe, you're somehow a failure at life. But when we sat down together and actually did the math, she kept an extra $3,500 of her paychecks throughout the year. She used that money to max out her Roth IRA, which grew about 7% in the market. And after paying the $800 tax bill, she was still ahead by $245. That's called winning. And let's be real, having that extra cash month to month, it meant she wasn't stressed every time her car needed new tires. She wasn't slapping emergencies on a credit card. She had control, not just once a year, all year long. Now, important sidebar. I'm not saying you want to owe $5,000 and get hit with IRS penalties. That's a hard no. To stay penalty free, you need to either pay 90% of what you owe for that year or 100% of last year's taxes, 110% if you're a higher earner. But if you owe a few $100, that's actually a good thing. It means you didn't overpay, you didn't play yourself, you kept your money in your wallet where it belongs. And here's the real mind shift. Getting comfortable with owing a little bit means you're no longer just hoping for the best. You're managing your money like a grown adult. Now let's tackle another fear that's probably lurking in your brain. What if I can't pay what I owe? First of all, if you adjusted your holdings correctly, you now have extra money in your pocket all year long. And some of that cash should be stashed away. 3, 2, 1. First of all, if you adjusted your withholdings correctly, you had that extra money in your pocket all year long. Some of that cash should have been 3, 2, 1. First of all, if you adjusted your withholdings correctly, you've had extra money in your pocket all year. Some of that cash should have been stashed away for this exact moment. That is what we call an emergency fund. And if that cash wasn't put in an emergency fund, deep breath. It's not the end of the world. Set up a tax day savings account right now. Even transferring 50 or $100 per paycheck builds up a cushion. If worse comes to worse and you do owe more than you can pay, the IRS has payment plans. They're not fun, but they're also not predatory. Their interest rates are way lower than credit cards, and if you're living paycheck to paycheck, flexibility matters. 3, 2, 1. If worse comes to worst and you do owe more than you can pay, the IRS has payment plans. They're not fun, but they're not predatory. Their interest rates are way lower than credit cards, and if you're living paycheck to paycheck, flexibility matters. Bottom line, owing a little money at tax time does not mean you failed. It means you played it smarter than most. You're keeping your cash and having it work for you, not collecting dust in the government's hands or being used on something you may not necessarily agree with. All right. Now that I've got you all fired up about keeping more of your money, let's talk about action steps. Because knowing the problem without fixing it, that's just complaining. And you and I, we are not complainers. Here's how you actually pay less in taxes and stop handing out interest-free loans to the IRS like it's your side job. Step 1, adjust your withholding. First stop, HR. March yourself into that office or really log yourself onto that payroll system and fill out a new W-4 form. Spoiler, the W-4 was supposed to be made easier a few years ago. Spoiler number 2, it's still confusing. But here's what matters. Step 2 covers multiple jobs or working spouses. Do not skip step 2 if it applies to you. Step 3 is where you claim dependents and tax credits. That's the child tax credit. Step 4B is the money move. You can reduce the extra withholding happening right now. If you usually get a $2,400 refund, that's $200 a month you could be seeing in your paycheck today instead of 11 months from now. Not sure where to start? Does it still sound super overwhelming? Use the IRS withholding estimator. Yes, it's a government tool, but guess what? It's actually helpful. It'll tell you exactly how to tweak your W-4 to get the result you want. Smaller refund, break even, or even owe a little. Pro tip, check it out twice a year, once in January and then again in June or July. Life changes, jobs change, pay change. Be proactive. So let's go through a real life example. Let's say you're married, 2 kids, and a combined income of $110,000. Let's just 3, 2, 1. So let's talk about a real life example. Let's say you're married, 2 kids, and a combined income of $110,000. If you just let the default withholding ride, you're probably getting a big fat $4,000 refund. It's cute. But if you adjust, real life example, let's say you're married, 2 kids, and a combined income of $110,000. If you just let the default withholding ride, you're probably getting a fat $4,000 refund. Now, if you rewind yourself to 15 minutes ago before you pressed play on this podcast, you'd be thinking, that's awesome, $4,000, that's amazing. Now, how do you feel about that big fat $4,000 refund? Hopefully you're not as excited. But what happens if you adjust your withholding? You're adding $333 a month back into your budget. That's real life-changing money every single month. Step 2, max out your tax-advantaged accounts. Translation, shove as much 3, 2, 1. Step 2, max out your tax-advantaged accounts. Translation, shove as much money as you can into places the government can't touch yet. Your 401k and traditional IRA. That lowers your taxable income today. For every $1,000 you put into a 401k, you save about $220 in taxes if you're in the 22% tax bracket. Health savings accounts, also known as HSAs, the unicorn of tax shelters. You get a deduction going in, you also get tax-free growth, and you get tax-free withdrawals for medical expenses. Triple win. For 2024, you could have stashed up to $4,150 as an individual. 3, 2, 1. In 2024, you could have stashed up to $4,150 as an individual or $8,300 as a family, plus a $1,000 bonus if you're 55 and older. Fun fact, after 65, you can even use your HSA money for non-medical stuff without penalty. You'll just pay income tax like a regular IRA withdrawal, which makes it a stealth retirement account with superpowers. So moral of the story, use every tax-advantaged account you qualify for. Stack those, okay. 3, 2, 1. Step 2, max out your tax-advantaged accounts. So what does this mean? Shove as much money as you can into places the government can't touch yet. So those places are, first, a traditional 401k and a traditional IRA. And what those accounts do is they lower your taxable income today. For every $1,000 you put into a pre-tax 401k, you save about $220 in taxes if you're in the 22% tax bracket. Another way is a health savings account, also known as an HSA. HSAs are the unicorn of tax shelters. You get a deduction going in, you get tax-free growth, and then you get tax-free withdrawals for medical expenses. Triple win. In 2025, you can stash away $4,300 for a self-only coverage and $8,550 for family coverage. Individuals 55 and older can make an additional catch-up contribution of $1,000, bringing the total to $5,300 for self-only and $9,550 for family coverage. Fun fact, after you're 65, you can even use your HSA for non-medical stuff without penalty. You just pay income tax like a regular IRA withdrawal. That is a stealth retirement account with superpowers. Moral of the story, use every tax-advantaged account you qualify for. Stack those tax savings like a boss. Step 3, track deductions and credits year-round. Don't be that person rummaging through a box of crumpled receipts in March. Be better. Use a spreadsheet, use an app, use a notebook with glitter pens. I don't care. Just track it. Do whatever works for you. Look for charitable 3, 2, 1. Look for charitable 3, 2, 1. Look for charitable donations. $20 here and there adds up. Education expenses, home improvements, energy efficient upgrades are gold. Business expenses if you have a side job, student loan interest, medical bills if they're high enough. And don't sleep on these credits either. The child tax credit, up to $2,000 per kid. Last episode, I talked about how expensive kids are. Today, I'm telling you, they're adorable little tax credits. The American Opportunity Credit, up to $2,500 for college expenses. Earned income tax credit is huge for moderate income families. Tax credits are magic because they knock dollars off of your tax bill. They just don't reduce your taxable income. 3, 2, 1. Tax credits are magic because they knock dollars off your tax bill. They don't just reduce your taxable income. Step 4, know your filing status. Listen up. Filing single when you qualify as head of household is like burning money. Your filing status affects everything: your standard deduction, your tax bracket, and what credits you qualify for. So heads up, if you're married filing jointly, the standard deduction is $29,000. Step 4, know your filing status. Listen up. Filing single when you qualify as head of household is like burning money. Your filing status affects everything: your standard deduction, your tax bracket, and what credits you qualify for. So heads up, married filing jointly, standard deduction is $30,000 in 2025. Head of household, $22,500. Single is $15,000. Supporting a kid or parent, claim that head of household status if you can. It's a total game changer for your bottom line. Step 5, hire a pro if you need one. TurboTax is cute. They have the cute commercials. They can be helpful. But there's a big difference between filing your taxes and strategically planning your taxes. A good CPA, certified public accountant, or EA, enrolled agent, is worth their weight in gold. True story. I know someone who saved over $4,000 the first year she stopped DIYing her taxes. $4,000. A good CPA, certified public accountant, or EA, enrolled agent, is worth their weight in gold. True story. I know someone who saved over $4,000 the first year she stopped DIYing her taxes. 4,000. Even if you see a pro every few years for a tax tune-up, it can catch mistakes you didn't even know you were making. And reminder, if you're self-employed, have side hustles, rental income, a trust fund, own a lump. Reminder, if you're self-employed, have side hustles, rental income, a trust fund, own a llama farm, basically anything more complicated than a W-2 job, get help. There is your 5-part action plan. Adjust, contribute, track, file smart, get help if needed. You are officially no longer handing Uncle Sam a gift card every year. All right, let's talk about the gold standard, the dream scenario, the power move, breaking even on tax day. That's right, not owing a huge chunk, not getting a giant refund, just a nice, boring, predictable outcome where you pay exactly what you owe and nothing more. Chef's kiss. Breaking even means you've mastered the art of paying what's legally required and not a penny more. That is financial adulting at its finest. But here's the deal. Getting to break even status is not automatic, and it's not set it and forget it. You've got to check in on your tax situation like you check in on a toxic ex's Instagram when you're bored. Here's what you absolutely must revisit on your W-4. Got married? Ding, ding, ding. New tax bracket, new filing status. Got divorced? Ding, ding, ding. New tax bracket, new filing status. Had a baby? Congratulations. Here's an adorable new tax credit and deduction. Bought a house? Mortgage interest plus property taxes equals maybe you're itemizing now. Started a side job? Now you're the boss and the tax department. Got a big fat raise or bonus? First, go you. Second, it probably changed your withholding needs. Translation: any big life change equals time to check your W-4. Set a calendar reminder for July. Just around the same time you're celebrating America's birth, mid-year is perfect to catch mistakes before they snowball into a nasty surprise next April. So let's look at a quick example. You're married, filing jointly, 2 kids, earning $120,000 combined. You got mortgage interest and property taxes totaling about $15,000, and you give $2,000 a year to charity. Cool, but guess what? The standard deduction for 2024, no, I don't want that. This 3, 2, 1. Cool, but guess what? The standard deduction for 2025 is $30,000. So you're probably not itemizing anymore unless you go above that $30,000 number. You'll likely snag a $4,000 child tax credit too. Remember, the credit reduces your tax bill, which is $2,000 per kid. All of that, it matters when you're dialing in your withholding. You can use the IRS withholding estimator to crunch the numbers or just look at last year's return as a baseline. Real talk. If you got a $3,000 refund last year and nothing major changed, adjust your W-4 to get about $250 more each month now. If you owed $2,000 last year and it hurt, adjust to withhold an extra $170 or so per month this year. And hear me on this. You don't have to hit exactly zero. That's basically impossible unless you have a crystal ball, but it's kind of fun to try, right? But the sweet spot is aimed to be within $500 either way. Owe a little or get a small refund. That gives you a safety net without leaving thousands of dollars on the table. Now, what if you still owe more than you expected? Don't spiral. It's okay. The IRS isn't sending you to money jail. They offer payment plans that are way less painful than your credit card interest rate. Short-term plans up to 120 days have no setup fee. Longer-term plans have a small fee, but it's manageable. The interest rate, typically around 3 to 4% plus a 0.5% monthly penalty. Not ideal, but not burn your house down bad either. But again, This is why you need to make sure you have an emergency fund. Owing the government a little bit of taxes is what I would declare a 3, 2, 1. And this is why you can use 3, 2, 1. Owing the government a little bit of tax time is a perfect reason to use your emergency fund. And I would call it an emergency. You need cash quickly. That is what your emergency fund is for. So that extra money that you're getting in your paycheck, instead of paying Uncle Sam, put it in your bank account, to ideally a high interest earning bank account. Get interest on that money. And then if you do end up having to owe, you can access that cash that you've been socking away and earning interest on. Remember, the government's not giving you interest for the loan that you're giving them. So you might as well keep a little bit of extra money for yourself and earn interest on it, then pay Uncle Sam. And again, if you still need to work out a payment plan, you can. You're not going to money jail, and it's way less painful than building up debt throughout the whole year. So let's go through a quick story. So again, I've been beating this drum for a long time. So I had another friend. No, I'm not doing that. So let's do a quick story. So let's say you adjust your withholdings to get an extra $300 a month. Good job. But then you have surprise freelance income and you end up owing $1,800 in taxes. You applied online for an installment payment, paid it off over 6 months, and the total interest and fees were about $70. Way cheaper, way less stressful than scrambling or going into credit card debt. Moral of the story, owing a little is fine. Planning ahead is better. Freaking out, optional. All right. Now that I've convinced you and you're adjusting your withholdings like the boss you are, you're probably wondering, okay, smarty pants, what do I actually do with this extra money now? Because if you're not intentional, that's $200 or $300 a month. It's going to disappear faster than you can say target run. And that, my friend, would be a waste of all of this effort. So here's the game plan. First, automate it. Don't even give your 3, 2, 1. First, automate it. Don't even give yourself the chance to blow it on dumb stuff. Set up an automatic transfer on payday. Boom, money's out of sight and safely. 3, 2, 1. First, automate it. Don't even give yourself the chance to blow it on dumb stuff. Set up an automatic transfer on payday. Boom, money's out of sight and safely working for your future before you can even think about adding another subscription box. Move it into a high yield savings account, a brokerage account, or send it to an extra debt payment. 3, 2, 1. Move it into a high yield savings account, a brokerage account, or pay off debt. Make it so easy that you can't mess it up. Second, build your emergency fund. Don't have one yet? Start here. Your emergency fund is your financial bulletproof vest. It's the thing standing between you and absolute panic when life decides to throw you a curveball. 3 to 6 months of essential expenses in a high yield savings account equals freedom. Freedom to quit a toxic job, freedom to handle an unexpected car repair without selling a kidney, freedom to sleep soundly at night. Third, boost your retirement savings. Already got an emergency fund? Good job. Next step, retirement. That extra $200 a month, drop it into your 401k or IRA. You're adding $2,400 a year your future self would thank you for. Invested that over 20 years at a 7% return, that's over $30,000. Not bad for money you used to hand over to the government with a smile. 3, 2, 1. Third, boost your retirement savings. Already got an emergency fund? Good job. Next stop, retirement. That extra $200 a month, if you drop it into your 401k or IRA, you're adding $2,400 a year your future self is going to be delighted over. That $2,400 invested over 20 years at a 7% return, that's over $30,000. Not bad for money you used to hand over to the government with a smile. 3, 2, 1. Not bad for money you used to hand over to the government with a smile. Or if I really want to rock your world right now, take that $2,400 and put it in an or let me rock your world for a second. Take that 24. Third, boost your retirement savings. Already got an emergency fund? Good job. Next up, retirement. That extra $200 a month, if you drop it into your 401k or IRA, you're adding $2,400 a year. Invested over 20 years at a 7% return, that's over $30,000 your future self is going to be very grateful for. It's not bad for money you used to hand over to the government with a smile. Fourth, smash high interest debt. Are you carrying credit card balances at 18% or higher? That extra money is your golden ticket out. Let's say you have a $5,000 balance, only making minimum payments. You'll be chained to that debt for 4 years and fork over $2,000 in interest. But if you toss that extra $250 a month at it, you're free in 13 months and you just save $1,500. Boom. Fifth, save for short-term goals. Dreaming of buying a new house, planning a big trip, want to replace that ancient laptop that sounds like it's about to take off into space? Use this money to make it happen without debt, without drama, without regret. The key here is intentionality. Direct your money where you want it to go before it finds somewhere stupid to go. And trust me, it will find somewhere stupid to go if you don't. Automation plus intention equals unstoppable. Here is your tax day mic drop moment. Your tax refund. 3, 2, 1. Here is your tax day mic drop moment. Your tax refund was not a bonus. Owing a small amount, not a failure. You managing your money all year long, total power move. You don't have to be a tax wizard to stop getting played. You just have to stop defaulting to the old refund equals good mindset. Who even created that mindset anyway? This isn't about cheating the system. It's about playing the system better. Pay what you're legally. 3, 2, 1. This isn't about cheating the system. It's about playing the system better, working smarter and not harder. Pay what you legally owe. No more, no less. We do not get a gold star for paying the government more money than we're supposed to. Keep your money working for you, not being used for God knows what in Washington. And listen, if getting that big refund really is your best shot at saving money right now, I get it. I'm not here to judge. Personal finance is personal. You have to do what works for you, but I challenge you to level up when you're ready. Start small if you need to. Adjust your withholding to get just $50 or $100 more in your paycheck. Set up the automatic transfer. Start building the habits that put you in control. Because financial power isn't about how much you make, it's about how much you keep. You've got way better plans for your money than loading it out to the IRS for free. 3, 2, 1. You've got way better plans for your money than loaning it out to the IRS for free. Go make them happen. Thanks for hanging out with me today on Everyone's Talking Money. Thank you for letting me get on the Stop Celebrating Your Tax Refund soapbox. I do it every time this year. Thanks for hanging out with me today. Thank you for allowing me to get on the Stop Celebrating Your Tax Refund soapbox. I do it every year about this time. If you love this episode, subscribe, share it with a friend who treats their tax refund like it's Christmas morning. Come hang out with me on Instagram at Everyone's Talking Money for more money truth bombs. Until next time, stay smart, stay savvy, and keep minding your money.